The great transition has arrived with important implications for investments. So I'm talking about the transition from unprecedented policy support to withdrawal of central bank intervention and eventually interest rate rises. Unless there is a significant change in economic circumstances, the US Federal Reserve will start tapering its asset purchases from November of this year at a rate of 15 billion US dollars a month to complete the whole process by June of next year. Now, US Treasury yields are likely to rise further, and that will likely be accompanied by persistent high inflation. Well, may the Federal Reserve say inflation is transitory, but the data has not been backing down. Energy prices from coal to natural gas to crude oil have gone through the proverbial roof. Meanwhile, supply chains remain badly disrupted by the pandemic. And all of that is showing up in a relentless surge in producer price inflation around the world. Beyond the taper, interest rates loom. The median view of the Fed's FOMC members regarding the appropriate Fed funds rate for 2022 has lifted from 0.1% at the June FOMC meeting to 0.3% recently. That means the median view of the FOMC members is the rates liftoff should happen next year. Now, all of this will likely slow US stock returns, US equities returns to a crawl because valuations are inverse to the discount rate. Rising US rates and yields are typically not good for emerging markets either. So investors have to be very selective. So how do you pivot your portfolio for this great transition? We have 5 ideas for you. Number 1, choose value stocks over growth stocks. The MSCI World Value Index has started to outperform the MSCI Growth Index very recently. And I think that's going to continue. So value stocks are sectors such as financials, healthcare, and consumer staples, among others. Banks in particular are defensive in this environment because rising rates can help raise their net interest margins. Growth stocks, as defined by the MSCI World Growth Index, is dominated by tech. Now, rising interest rates pose a particularly difficult challenge for tech stocks because a larger part of their valuations is in more distant earnings. So they will suffer more duration risk than stocks in more traditional sectors. Idea number 2, energy stocks. I had been recommending the oil majors since middle of last year when West Texas Intermediate crude was trading in the range of US $30 to $40 a barrel. It is now trading over 83 US dollars a barrel. Now, energy stocks, to be clear, have rallied big time. The S&P 500 Energy Sector Index is up 152% from its March 2020 low. So we are probably in the second half of the game, as it were, maybe even the final quarter. But with supplies of coal and natural gas unable to cope with demand and OPEC Plus holding back crude oil supply, we could see yet higher prices as we approach the northern winter. Idea number 3, Japanese stocks. The strengthening of the US dollar in response to higher US Treasury yields has driven dollar yen from 109 to 114 in less than a month. A weak yen is a boon for Japanese exporters. Now, I reckon this could continue to support Japanese equities in coming months. Idea number 4, Chinese equities. They are out of favor and beaten down. But the CSI 300 has seen some tentative support at the bottom of an uptrend channel from the year 2009. The negativity around China is overdone. The economy will stay resilient despite Evergrande's financial troubles. Manufacturing will likely continue mostly undisturbed through the winter, despite reported energy shortages. I see value in Chinese equities for long-term investors. Number 5, the US dollar. Higher US Treasury yields, particularly at the short end, are generally supportive of a stronger US dollar. Now, mind you, the dollar has gone up a lot in recent months and could soon stage a correction. But I see a resurgence of a strong dollar next year as we approach interest rate rises in the US.